Good day, Doctor and my fellow friends. I'm SHAANTHA PERUMAL, mention number is 280865. We are from Group 7 and would like to present about our group assignment. So these are my group members who are going to present in detail for each questions in our group assignment. These are the 10 companies selected from different sectors such as plantation, energy, and technology. This is our table of content where we will present questions 1, 2, 3, and 4, where you will watch in detail later on. Well, here I would like to present question 1, where we use the disaggregated measures of asset turnover, which were already discussed in topic 4, in order to find out the effectiveness of management in generating sales from the company's operating assets for the selected companies. There are 8 disaggregated measures of asset turnover to determine the effectiveness of management in generating sales from the selected companies, such as account receivable turnover, average collection period, inventory turnover, average inventory days outstanding, long-term operating asset turnover, accounts payable turnover, average payables days outstanding, and the net operating working capital turnover. First ratio is account receivable turnover. According to the annual report, the account receivable turnover ratio showed a huge growth in Sarawak Oil Palm Berhad Company compared to the Bumi Armada Berhad. Therefore, the higher the account receivable turnover ratio, the better for receiving payments for debts. Next is according to the annual report, the average collection period of TDM Berhad has a greater potential to collect payments from the clients or customers in a shorter period of time and be able to settle the company's debt obligations than DLM Berhad. Moreover, inventory turnover refers to the average number of times inventories are obtained. Based on the annual report data, it shows that the inventory turnover ratio of Sime Darby Plantation Berhad is higher and has the capability to generate more sales compared to the Sarawak Oil Palms Berhad. Besides, based on the annual report, the average inventory days outstanding of TSH Resources Berhad is better than Withrox Corporation Berhad because Withrox Corporation Berhad has a higher ratio where the company is unable to convert its inventory into sales. Furthermore, the long-term operating asset turnover ratio of Willow Glen MSC Berhad is better compared to Karami Petroleum Berhad because the adjustment made in long-term operational assets on a company's balance sheet might determine the capital investment or liquidation. Next, accounts payable turnover of Dayang Enterprise Holdings Berhad is better than Willow Glen MSC Berhad because an increased ratio indicates that the company has enough cash on hand to pay back its short-term debt in time. In addition, average payable days outstanding of Bumi Armada Berhad is better than Karami Petroleum Berhad, since Karami Petroleum Berhad struggles to pay its creditors when the average payment days outstanding is high. Finally, in 2021, the net operating working capital turnover of Bumi Armada Berhad is above 1.5, and it should maintain its net operating working capital turnover ratio to over 1.5 ratio in order to generate revenues effectively. Thank you, that's all from me. Next, I will pass to the next presenter to present about the question 2 in detail. Thank you.
Good day, Doctor and everyone. My name is Lo Qingxian. My metric number is 279700. Now I am going to identify which of the disaggregate measures of asset turnover affect a company returns on net operating asset, which also known as RNOA. This is a multiple linear regression equation that will be formed by using the estimated coefficients of the dependence and independence variable. From here, we know that the RONA are the dependence variable, while disaggregations of the asset turnover are the independence variable. By checking all the question line, there are no missing value in this 10 company over the 7 years. Based on the moral summary, it is shown that the dependence and independence value have a high correlation as its R value is at 0.739, which is higher than 0.4, while its R square value is at 0.546. It's good as it shows that the approach can be used to assess how the dependence and independence variable are detected. Well, according to the ANOVA table, the SIG value shows 0, which is less than the 0.05. The SIG value below the tolerant value of 0.05 to be considered as significant to the dependence variable. This is the hypothesis statement for this study. According to the table coefficients, all disaggregations of asset turnover such as account receivable turnover, average correction period, inventory turnover, average inventory day outstanding, account payable turnover, average payable day outstanding, net operating working capital turnover are not statistically significant impact on RNOA because they have a p-value higher than 0.05. Then it fails to reject H0. However, the long-term operating asset turnover will significantly affect the RNOA as it has a p-value of 0, which is lower than the alpha 0.05. As a result, the H0 will be rejected and H1 is accepted. In conclusion, based on this table above, we know that the long-term operating asset turnover can affect a company RNOA. This is because it has a significant relationship and have a positive correlation with RNOA since beta value equals to 0.065. That's all for me, thank you, and I would like to pass to the next presenter.
Assalamualaikum and good day everyone. My name is Tasha binti MALLARANGENG with metric number 280809. So now I'm going to proceed with question 3, which is evaluate the credit analysis of the selected companies and discuss the advantages of each ratios related to the credit analysis. So here are the list of financial ratios that related with credit analysis that will be discussed in this question. So the first one is current ratio. Current ratio determines the capability of a company in fulfilling their short-term obligation, which commonly due in less than 1 year. So this ratio helps the investors, creditors, or even the supplier to discover a company's financial health and liquidity position, especially in the short-term period. So the prediction of this ratio is that the greater the current ratio of a company, the lower the risk of a company to settle back its current debt obligation. The second ratio is quick ratio. So this ratio also determines a company's ability in fulfilling its current debt obligation. So relating with the name of quick, this ratio only includes the most liquid asset, which also called as quick in the calculation, such as the cash and cash equivalent, account receivable, and marketable securities. So since we know that the creditors and suppliers are expecting an early or well-timed payments from their borrowers, so this ratio is very suitable for them to predict the borrower's financial condition in repaying the instant liabilities. So to measure the quick ratio value, the ratio above 1 shows a sufficient amount of money to cover the short-term debt, while conversely, the ratio below 1 indicates an insufficient amount of money to fulfill the short-term obligation. Next is cash ratio. The purpose of this ratio is similar with current and quick ratio, that is to measure the company's capability in repaying their current debt or current liabilities. So in most cases, this ratio is not often used by the analyst compared to the previous ratio. However, it is useful to analyze a company's past year performance rather than the future cash inflows. It is because when we use the future cash inflows, it makes us an overstated or understated value in the result. So this ratio is more preferable for companies that tend to keep a cash on hand in handling their business operation. For debt to asset ratio, it is used to evaluate the percentage of companies' asset in financing their debt obligation, where it involves both short-term and long-term debt in the calculation. This ratio helps to predict the financial risk of a company by looking at the total debt and their efficiency in repaying the overall debt. So from that prediction, the creditors can decide whether they want to extend an additional loan to their borrowers or not. In measuring the risk, the borrower risk, The ratio of debt to asset below 1 will indicate a lower level of leverage and risk from that borrower, while a ratio above 1 indicates a higher level of leverage and risk from the borrower. So for total debt to total capital ratio, this ratio helps to overview the capital structure and financial efficiency in a company. Other than that, it also helps the investor in deciding a potential companies for their investment purpose. So this ratio predict that the higher ratio of total debt to total capital ratio in a company, the higher the risk of that company, which also mean that the company has a lower capital value to cover its overall debt. So that's all from me, and I will pass to the next presenter to explain about the remaining ratios that related with credit analysis.
Good day, Dr. Badru and fellows. My name is SALSYABILA BINTI SALLEH, metric number 280042. I will continue to elaborate the question 3. Next, we have employed the debt to equity ratio as another ratios under the solvency ratios. The advantage of having a high debt to equity ratio means that a firm can meet its debt obligations, also being used to boost equity returns and drive growth strategy. Debt to equity ratio is less than or equal to 1 indicates a firm is less risky in terms of debt payments. Next, we have used the equity ratio. The advantage of this equity ratio is that this ratio is able to determine the value of the assets financed with owner equity. Other than that, firm with significant value in equity ratio would give the advantage to the potential investor and creditors, as the company can pay its debt on time and will not risk to insolvency. Furthermore, the long-term debt to equity capital ratio. This ratio helps in credit analysis to analyze how much long-term debt are being used by firms to finance its asset relative to the shareholders' equity. Hence, firm may be able to raise funds to pay their long-term debt when maturity and also buy back stock when interest rates low. Next, the next one is short-term debt to total debt. The advantage of this ratio is that a credit analysis of the organization will be convenient if the company uses short-term debt as its capital funds. Also, short-term debt is crucial to fulfill the urgent emergency needs and act as a lifesaver. Also, increase the short-term debt will increase the credit worthiness. These two are the coverage ratio that we employ to evaluate the credit analysis of the selected companies. First, the interest coverage ratio. The advantage of this ratio is it is showing if the company has high interest ratio, then the firm has high capacity to cover its interest payment. Next, the firm as well as earns more EBIT rather than spends on interest, and so on, as you can see on the slides. Finally, is the assets coverage ratio. The advantage of the assets coverage ratio in credit analysis is that it signifies the firm's ability to meet its financial obligations. Next, high value in this ratio is supposed to be less risky to the firm as well as assess the credit worthiness. That is all for answering the question 3. We hope our extensive answer just now were able to meet your expectation.
I'm JESSIE Wong with metric number 277975. I'm going to explain whether the chosen factors can affect earnings per share, EPS, and price to earnings P ratio. First, the chosen factors are company value, capital structure, feasibility, tangible, productivity, current ratio, and board size. The regression analysis was applied, and the independent variables are the 7 chosen factors, and dependent variables are EPS and PE ratio. This is the result of regression analysis for the factors with EPS. This is the equation of EPS and the 7 factors. Next, all the independent variables are entered, and the entered method is users. Next, based on the model summary, the R-square value 0.39 is considered as low effect size for the sample. However, this sample still can proceed with the next step as long as the R-square is larger than 0. Next, the p-value in ANOVA table 0.000 represented that is a statistically significant between the variables. But followed by the coefficient table, only the tangible and productivity have a p-value are lower than 0.05. The others variables are higher than 0.05. Therefore, we can conclude that the tangible and productivity can affect EPS as they have the relationship between each other. Next, this is the result of regression analysis for factors with PE ratio. All the independent variables are entered and the enter method is used. Based on the model summary, the R-square value is 0.424 and consider as we can proceed with the next step. Next, the p-value in ANOVA table 0.000 represented there is a statistically significant between the variables, but followed by the coefficient table, only the visibility has a p-value of 0.00, which is lower than 0.05, and the other variables are higher than 0.05. Therefore, we can conclude that the visibility can affect the P ratio as that has a relationship. All in all, the tangible and probability can explain the change of EPS, while the visibility can explain to PE ratio. That is all from us. Thank you for your time.